Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. We are talking about banks. It's Bank Week version 2.0. Last week we did some macro previews for the financial sector as well as banks. And we also touched on Citigroup, Wells Fargo, and JP Morgan leading up to their earnings reports, which happened, last Thursday? April 13th, I think it was the date. We're doing it again. We're recapping, so make sure you hit subscribe on YouTube, youtube.com/TuskMediaLLC. We're verified now, so it's much easier to find us. So hit subscribe there. You can check out all the videos. Also, if you're following along on Seeking Alpha, we appreciate your feedback. Leave us comments and talk about how Ben's sophomoric or whatever it may be.
Lazy-minded.
Feel free to roast Ben in the comments. But today, right now, we're going to be talking about Citigroup. An interesting story. I felt like it was one of the more intriguing stories heading into this earnings. Among the three, we kind of expected JP Morgan to do well. We felt like Wells Fargo was going to be, really a company looking to rebound its image as much as anything. But Citigroup was, we were kind of on the fence on where they were going to go. It's a very diversified bank in terms of just geography as well as what they're trying to do. What's just kind of some initial impressions from Citigroup's earnings?
Well, as we talked about with JP Morgan, the trading revenue was kind of the headline. They also had a number of one-time items, both on the expense side as well as the revenue side. But right now they're just trying to get to a position where they're not breaking stuff out as much. For example, Citi Holdings is now being incorporated in the regular corporate segment. Citi Holdings is the bad bank that they lumped all the bad assets into after 2008. So that's being wound down, but that's still having an impact on operating results now. Big headline, I think, is the fact that the tangible equity ratio, the capital equity ratio, is much better than expected, and actually far outside the range for where Citi wants to be. Citi wants to be in 11 to 11.5%, talking about something at 12.8% right now. So that could bode well for their CCAR demands and what they want to return to shareholders in terms of share repurchases and dividends. So I think that's a big story. Loans and loan growth is a big story. And then what I thought was going to be a bigger story, quite frankly, but turns out not to have been, was just the impact of interest rate increases and the relative lack of focus that's attracting either from analysts and even from management too.
That's I think one of the things that was most interesting kind of across the board. The dominant story really in investing for the last couple of years. You've had the election and Brexit, but the theme that we've been talking about year after year, quarter after quarter, month after month has been interest rates, and especially when you start to think about banks and net interest income. Kind of interesting to see it basically be a non-factor now that we're actually getting rate hikes. Citi came out and they said they do expect another rate hike in June. But what's interesting to me and what's compelling, and again, some of this could have been modeled out, but a 25 basis point rate hike for them, it's not a huge needle mover.
No, so it'll a 25 basis point rate hike. That'll help their quarterly pre-tax earnings by about $100 million. So you think the annualized impact of that's $400 million. If you get 2 rate hikes, then that's $800 million annualized. So that starts to become a more significant number. There's about 2.7 million shares outstanding. Cut it back by 30%. You're talking $500 million on 2.5, so 25 cents, or 20 to 25 cents for 2 rate hikes in EPS. The company's earning $5 a share.
Right.
So, like you said, it's a nice boost. It's a good tailwind, but it's not a huge needle mover when you really want their EPS to be increasing by about 10% a year. You're not covering all that with interest rates by any means.
Especially when you start to think about another thing that we've talked about really with all these banks is the slowing of loan growth and loan originations. And you kind of made the point in our macro video earlier today that you think a big part of that is just slowing in refinancing, which certainly makes sense from a human component. I think that's sometimes challenging for us as investors to think about how does Main Street actually think about things. And obviously, as rates go up, it becomes less and less attractive to refinance into that. We're starting to get into a point in the cycle in which rates are going to be higher for refinancing relative to just keeping your existing interest rate. And that certainly seems like something that could weigh City down a bit.
Yeah, and then coupled onto that, if you're thinking about just the second quarter now with the rally in rates, I mean, does that actually provide a acceleration for loan origination, especially going into a seasonally strong period for housing? So that could be a positive spin on it, but the broad point is still the same, that the higher interest rates means it's simply more expensive to get a loan, and you can afford less house. Like if interest rates are 6% versus 4%, you are not going to be able to buy as much dollar value of a home, and when banks are paid origination fees based on the dollar value, they start to that total origination value looks lower.
The thing that was interesting, I think, heading into earnings with Citigroup is we felt like earnings would be an interesting kind of update, so to speak. Didn't really feel like we were going to glean a whole lot necessarily from the bank. Again, you want to see kind of a checkpoint. But the thing that we were really interested with Citigroup heading into this is CCAR, and kind of the comprehensive capital review. What's going on there in terms of how is this bank actually looking in the eyes of regulators, in the eyes of the Fed? And I think the real thing we're looking at right now is CCAR, the results for Citigroup, and what happens really with their dividend and what we can be expecting. What's the storyline there?
Now that's a great point, because I've always kind of viewed Michael Corbat, who's the CEO of Citi, as kind of this very conservative, doesn't want to overstep his mark, doesn't want to really bring attention to himself, because he has plenty to do in cleaning up this bank. He actually came from the Citi Holdings. He was managing the bad bank down. So that's kind of where he's come from. So I think that still plays a role. But what was interesting was that took a little bit of a turn this quarter in the conference call. As we said, the CET1 ratio, which is kind of the barometer, that was 12.8%, up from 12.5% just the previous quarter. They generated, in this quarter alone, $5.5 billion of regulatory capital and returned $2.2 billion of regulatory capital. So the capital is already high at 12.8%, and it's only getting higher.
Right.
They want to get into a range of 11 to 11.5%. And so, if you look through the conference call, they say, quote, they feel good about the process, very good about our numbers, and our ability to make big asks, and we'll continue to work on it. So that is a really different take from Citi to what they've said in the past. I think they're going to be more aggressive with it. Last year they did $8.6 billion in share buybacks, $1.8 billion in dividends, which translated to a dividend yield of about 90 basis points. So it was more of a token than anything else. You see them focusing more on stock buybacks. That's an indication that they're just being more conservative. It's easier to get buybacks through and dividends, as we've talked about. But I think that there's a potential to at least double the dividend. At that point, you're still talking about $3.6 billion, and then maybe do $10 billion in stock buyback. You add those together, so it's about a 10 to 15% increase on the stock buyback, doubling the dividend. That would be a dividend of $130, yield about 2.2%, which is more in line with their banking peers.
Right.
For context, Bloomberg only expects the dividend to rise to 80 cents from 64 cents. I think they could do $1.30. And so if that would cost them about $14 billion, and they just generated $5.5 billion in regulatory capital in Q1 alone, and they're already running high. So I think that's a pretty manageable number. The headlines would be like, the Citi doubles their dividend. It sounds huge, but it's really not that much of a stretch to get there.
Not a stretch, but again, kind of a change of tone.
Yeah.
From laying low, flying under the radar, not wanting to disrupt anything, not wanting headlines about how they're actually deploying capital,
Right.
even if it's in a shareholder-friendly way. It certainly would be a change of tune
Yep.
to that regard. Ben, any other thoughts on Citigroup?
It just seems relatively cheap to me. You see most banks trading not only above tangible book value, but even above book value. Tangible book value for Citi is 64-ish. Book value is 74, 75-ish. And the stock's trading at 58, 59.
Right.
So I think that there's still a marked discount for Citi that, in my opinion, is unwarranted.
And in some regards, that it makes sense, and that some of the major themes that we talked about, and I think themes that a lot of investors were looking for to play out in this quarter's of earnings results, they didn't solely move the needle. And when you look at Citigroup, a bank that's pretty diversified, as we've touched on in a lot of different, no matter how you categorize diversification, they pretty much checked that box.
Right.
So they weren't necessarily the bank that was going to benefit the most from interest rates really taking off, or loan originations really taking off, or any of these things. So they weren't ever really going to benefit from this one catalyst. So because of that, I think they've maybe been overlooked a little bit by investors. But now they're in a good position if we're seeing, hey, all these things we thought would really move the needle didn't really do it.
Right.
They've covered a lot of bases, and they seem to be pretty well positioned.
Yeah, and then don't forget the improvement in Europe and Asia.
Right.
And the stabilization there. It seems like every year there's a question about China growth slowing or Europe crumbling. And if we don't have those headlines, which don't put the cart before the horse here, but if we don't have those headlines, then just not having those headlines should help Citi.
Yeah, absolutely. So yeah, it seems like they're a little bit undervalued in our opinion. They're also pretty well positioned. In interest of full disclosure, we do own Citigroup. We also own JP Morgan. We also own Wells Fargo. So all the banks we're touching on, we own. So for better or worse, we're right there with you. I think that's all we got. Make sure to check out our other videos on those three companies we just mentioned. Also have a macro recap of kind of the banking stocks that we've gotten earnings on so far. Y'all have a great day. We'll talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.